Thank you for joining Money Simplified, your guide to money and mutual funds, presented by Franklin Templeton Mutual Fund. We appreciate your participation. At PersonalFN, we are committed to help investors achieve their financial goals and objectives. Our core proposition is built around unbiased research and financial planning. We wish to thank Franklin Templeton Mutual Fund for partnering with us in this investor education and awareness initiative. Welcome to session 18 of Money Simplified, your guide to money and mutual funds. We are glad to have you with us for the 18th session on model portfolios based on risk appetite and time horizon. Alright, so now let's get started with our learning session today and see how you should build an optimal mutual fund portfolio based on a risk appetite and time horizon. In our previous lecture, we told you how to select winning mutual funds. Once you have done so, the next step would be to build an optimal mutual fund portfolio that can help you achieve your investment objective over a longer time period. But identifying right funds and building a mutual fund portfolio may not be a simple task. With over thousands of mutual funds available today, the task can become herculean and complex, as there may be funds that may not be doing what they say and hence may not be suitable for your portfolio. So you need to be careful. In today's session, we will tell you about how to go about building a mutual fund portfolio, and more importantly, we will tell you about how to structure a mutual fund portfolio based on a risk appetite and time horizon. So let's first understand the process of building a mutual fund portfolio. While there is no standard rule to do this, we can broadly divide the process of building a mutual fund portfolio into two steps. The first step involves eliminating mutual fund schemes, and the second step involves selecting the mutual fund schemes for the portfolio. So first let's understand the process of elimination. As you need to be cautious while picking a mutual fund for your portfolio, the process of elimination is important while building a mutual fund portfolio. You should clearly know what kind of mutual fund schemes may suit you, so that you can have the right funds in your portfolio and know what kind of funds you should avoid. Moreover, you should question the existence of every mutual fund in your portfolio so that you are left only with the funds that suit your profile. Now, while eliminating mutual funds, one has to keep in mind the following points. First, define your filtration criteria. Filtration plays an important role while selecting funds for your portfolio, as you may be looking for funds that have shown a consistent track record in the long run. You may not like to add funds that have no track record or less track record to show. Hence, you can have initial criteria like funds that have not completed a 3-year track record. With this, you will be automatically left with those that have at least a 3-year track record. You should clearly define and refrain from investing in schemes that may not be suitable for you. If you have a low risk appetite, then you can refrain from investing in sector or thematic funds, as such schemes have a tendency to plunge more during the downturn. It is best to opt for mutual fund schemes with a broad investment mandate championed by well-diversified equity funds. Eliminating all the sector and thematic funds would leave you with just the well-diversified ones. Then you should also limit the number of funds in your portfolio. It is important for you to guard yourself against over-diversification. Hence, you should limit the number of funds in your portfolio. Do not forget, your fund manager is already taking care of diversification, and hence there is little point in diversifying something that is already diversified. Then you should avoid duplication. If there are 2 or more mutual fund schemes that seem to be doing the same thing in terms of mandate or style, then you have to ensure that you are left with just the best in that category and eliminate the rest. So do a pure comparison. Then you need to eliminate the inconsistent performers. Finally, evaluate funds' performance over the long term, say 3 to 5 years, and over various market cycles. This will enable you to understand whether the equity fund under review has stood the test of time. Many momentum funds do reasonably well during a swift market rally in the short term, leading to investors to believe that they are well-managed funds. But do not forget, if the market had not appreciated sharply, the funds may have been one of the dismal performers over this period. It takes a bare face to separate the men from the boys. Eliminating such funds may help you shortlist consistent performers. Then we come to the process of selection. Once the elimination process is performed by the investors diligently enough, the second step will come naturally. For instance, if you have ignored all the sector and thematic funds, that leaves you with just the well-diversified ones. Likewise, if you have eliminated all funds that have not completed a 3-year track record, you are automatically left with those that have a minimum 3-year track record. So while selecting mutual funds for your portfolio, you must keep the following points in mind. First, select across market caps. Investors should have a mix of both large cap as well as mid cap funds, since both have their inherent strengths. When both are well selected, they can reward the investors handsomely over the long term. The proportion of investments in large cap funds will depend upon the risk appetite of the investor. For example, a 25-year-old person would have higher allocation towards mid cap funds when compared to large cap funds. Similarly, it also pays to invest in an equity fund that can invest in both large caps and mid caps depending on the opportunities. These funds are commonly referred to as opportunities or flexi-cap funds. Then you also need to select across investment style. Investors should go for both well-managed growth style and value style equity funds. This will help capitalize on opportunities across the board. Growth fund invest in well-managed companies that are likely to show high growth going forward, whereas value style funds invest in well-managed companies that are undervalued temporarily but have the potential to achieve their fair value in the future. Then you should also select across asset class. Investing in a mix of equity and debt or a hybrid fund can bring in stability to the portfolio on account of the provision in the investment mandate for investment in debt. But while deciding on the allocation between equity and debt, it is vital to judge your risk appetite and follow a prudent approach. To top it all, your selection process must purely be based on research and analysis. Your agent, neighbors and colleagues are welcome to air their views, but remember, at the end of the day, it's your own hard-earned money. Once you are aware about the process of picking up mutual funds to build a portfolio, the next step would be building an ideal mutual fund portfolio that can meet your investment objectives. So let's see what can be the different approaches to build a mutual fund portfolio. Building a portfolio based on risk appetite. Defining a risk appetite plays an integral role in building an ideal mutual fund portfolio. You can define your risk appetite as: first, aggressive risk appetite. Investors who have a penchant for making high returns by taking high risk can be termed as aggressive. Such investors can include high growth funds in the portfolio that can generate high returns in the future. Investors with moderate risk appetite may look for decent returns but at the same time would not like to take high risk. Such investors need to have a balance in their portfolio with both growth and stability. Conservative risk appetite. Some investors may not like to take risk with their money and hence prefer stability over growth. If you have a conservative risk appetite, then you should look for stable funds that have the ability to limit the downside risk during uncertain market conditions. Now the table here shows how you can allocate your portfolio to various categories of mutual funds based on your risk appetite. So while an aggressive investor can have high exposure to mid caps and such high growth funds, a conservative investor should have high exposure to large caps and balanced kind of funds that are known to be more stable. And as you can see, a moderate risk investor can have a mix of aggressive and stable funds in his portfolio. Based on your risk appetite, you should define an allocation to various categories of mutual funds that may be suitable for you, and then pick the best funds based on your parameters under each category of your portfolio. Then building a portfolio based on a strategy. You can optimize your portfolio by having a proper strategy. You should clearly know the purpose of each holding in your portfolio. So accordingly, you can classify the components in your portfolio into core holdings and satellite holdings. First, core holdings. The key and the stable holdings in your portfolio that you intend to preserve in your portfolio irrespective of the market conditions are your core holdings. The core holdings in your portfolio can help you steadily grow your wealth in the long run and may help you meet your extreme long-term goals. While satellite holdings in your portfolio are like toppings that can add flavor of extraordinary returns to your portfolio. These can be high risk, high return kind of funds that may add to your portfolio for your additional returns. But while doing so, you need to be ready to bear excess volatility that it may bring to your portfolio. Moreover, you may need to keep a close track of such holdings and take timely measures during unfavorable conditions. The portfolio table shown here is an example of a strategic portfolio. You see, the proportion of core and satellite holdings in your portfolio may vary based on your risk appetite. So a conservative investor would prefer stability over growth and hence would hold more of core holdings as they bring stability to the portfolio while having a low penchant for extraordinary returns. On the other hand, an aggressive investor would be ready to take high risk for high growth and maintain relatively high exposure to satellite holdings that can bring him extraordinary gains. And as we said earlier, investors with moderate risk appetite would maintain a decent balance between stability and growth as per their risk tolerance. Then comes building portfolio based on asset allocation. Diversification is the key to success of an investment portfolio. You should have proper diversification across asset class. Based on your risk appetite, you need to define a standard allocation across asset class, that is equity, debt and gold. While aggressive investors may have high allocation towards equities, a conservative investor should prefer relatively higher diversification to other asset class, mainly debt investments that can help maintain stability to the portfolio. Do not forget, you may need to review and change your standard allocation as you progress in your age and nearness to financial goals. Moreover, you need to regularly monitor and keep a proper track of your allocation, as your allocation to each asset class may vary over a period of time. You should review the allocation of your portfolio every 6 to 12 months, especially if there is a swift rally in any of the asset class. This will help keep your portfolio under control and you can take timely measures. So you need to timely rebalance your asset allocation. Moreover, you need to make sure that the allocation to each asset class in your portfolio is not deviating from the standard allocation you have set for your portfolio. And if it does, then you need to timely rebalance your asset allocation. So if your allocation to equity, debt and gold has moved from your standard allocation of say 60:20:20 to 70:15:15, then you can book the additional 10% growth in equities and shift it to debt and gold in order for the allocation to once again reach 60:20:20. The table here shows how mutual fund portfolio can be structured based on asset allocation. As you can see, the portfolio is spread across equity, debt and gold based on one's risk appetite. So if you are an aggressive investor, you may consider equity as a catalyst for wealth creation, whereby you hold 80% allocation in equity and just 10% allocation for each for debt and gold. On the other hand, if you are a moderate or a conservative investor, you would prefer to have a higher level of stability. So in such a case, you may hold lower exposure to equity and higher exposure towards debt and gold. So the allocation for moderate and conservative investor can be 65:25:15 and 30:50:20 respectively across equity, debt and gold. Further, under each asset class, you can define the allocation to various styles and categories of mutual funds that can cater to your investment needs. Then comes building your portfolio based on time horizon. Considering your time horizon is a must while building your portfolio. You cannot put your money in risky assets if you need it in the next 3 to 6 months or even 12 months. You should ideally reduce your allocation to risky assets if you're nearing your goal or you're having low time horizon. So accordingly, if you have short-term horizon, you need to have high exposure to low-risk asset class. On the other hand, if you have a medium-term horizon, you can have balanced exposure across asset class. Besides, if you have a long time horizon, you can have high exposure to risky asset class. As you can see in the table, investors having a shorter time horizon, that is less than 12 months, should have no exposure to equity and gold, while entire exposure can be in fixed income assets. But you need to be careful. Not all income funds are safe, and so you need to be very selective. And investors who have a medium to longer investment time horizon can increase their exposure towards equities and risky asset class with some exposure to gold. So once you have defined your investment time horizon, you can allocate your portfolio to the right category of mutual funds. So here are some key takeaway points for our today's session. You should follow a proper elimination and filtration process while building your mutual fund portfolio. Next, you should limit the number of funds in your portfolio. Make sure that you spread your portfolio across investment styles and market caps according to your risk appetite. So build your portfolio based on your risk appetite. As an aggressive investor, you can look for high growth funds. As a conservative investor, you would prefer stability and should hold stable funds in your portfolio. While as an investor with moderate risk appetite, you should maintain a fair balance between growth and stability. You should optimize the performance of your portfolio by having a proper investment strategy. You should define a standard allocation across asset class and timely rebalance your portfolio if it deviates from the standard allocation. Moreover, your time horizon is a must while building your portfolio. So to end our learning exercise today, we now invite you to test your learning by taking up this simple quiz and win exciting prizes. Thank you for participating. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.